What's up, you guys? Boris here with another episode of Finance Talk. Thanks for tuning in, you guys. Tomorrow is March 17th, 2021. Tomorrow is Fed Day. Tomorrow, the chairman of the Fed will be speaking, and the markets are often reactive to what the Fed has to say. The markets will either sell off or there'll be a green day, depending on what the Fed has to say. And so I wanted to go ahead and analyze some recent testimony that the Fed chairman, Jerome Powell, has made. And this is kind of clue as to what he's going to say tomorrow, and to kind of direct us on how we're going to trade accordingly. We want to be responsive traders. However, we also want to be well positioned ahead of time. We want to make sure our portfolios are benefiting from what the chairman has to say tomorrow. So in the past, the chairman has been dovish. He stated time and time again he's not fearful of inflation. He stated that they're not going to increase rates until the pace of unemployment takes a dramatic downturn. Furthermore, they want to target that 2% inflation rate. Even most recently, they stated they're a little bit more accommodating. That 2% is not a hard and fast rule. They're willing to accept slightly higher than 2%. So despite the Fed time and time again reassuring the markets that they will remain dovish, they're going to remain supportive of the marketplace. The marketplace is still jittery and responsive in response to inflationary fears. So why this fear in the marketplace? Well, typically the Fed leads the markets. However, the market is now fearful that the marketplace will lead the Fed as opposed to the Fed leading the marketplace. You're probably like, what the heck is this guy speaking in riddles? What am I talking about? Listen, you guys, what I'm stating is that the Fed is typically dovish, and the Fed is typically propelling the markets high after even further highs. But now the marketplace is fearful that they're going to lead the Fed away from their dovishness, and basically the Fed will become more hawkish, meaning the Fed is going to become less accommodative, less supportive of the marketplace. What I'm stating is the Fed is going to taper their bond purchases and increase interest rates. That's what the marketplace is fearful. The marketplace is fearful that instead of the Fed directing the market will direct the Fed. And how do we make that determination? Well, the Fed is looking at consumer staple prices. They aren't looking at whether the price of equities are inflated. They're looking at whether the price of consumer staples are inflated. So yes, the Fed is acknowledging that the equities market, the stock market, is inflated. Maybe commodity prices are inflated, like energy sector, for instance. But they're looking at consumer staples. How much does it cost for you to purchase groceries? How much does it cost for you to fill your gas tank? That's what they're looking at, consumer staples, every day. We're not looking at Wall Street, we're looking at Main Street, and that's how they did make the determination whether or not they're seeing real inflation. So,
so what I see is an economy where there's still a great deal of slack. I see the prospect of really significant progress as we put the pandemic behind us. As we see that data, we've got in place guidance that tells markets clearly when we will begin to taper asset purchases and when we will begin to raise interest rates, when the economy, in that case, when the expansion is very far advanced. So we have our tools, we have them in place, and we think that this is the appropriate policy stance. As I mentioned,
so you guys, what the Fed chairman is pledging to remain dovish on the economy, supportive of the economy. He's stating that as long as employment has a lot of room for expansion, as long as inflation remains tepid, they're going to continue to keep rates low, and they're going to continue to purchase treasury bonds. They're going to remain supportive of the economy, you guys.
Our tools work in the aggregate, as you know, at the economy-wide level. And I would just say that we do expect inflation to move up, both because of base effects, as I discussed yesterday, and also because we could have a surge in spending as the economy reopens. We don't expect that to be a persistent, longer-term force. So while you could see prices move up, that's a different thing from persistent high inflation, which we do not expect. And if we do get it, then we have the tools to deal with it.
So what he's saying, you guys, is that he does indeed expect inflation to tick up once the economy starts to reopen. A lot of people have been saving money. They haven't been spending because they haven't been able to shop for the past 12 months. Once the bricks and mortar stores such as Macy's and JCPenney starts to reopen, we're going to see a surge in consumer spending. And the Fed chairman is acknowledging that they do anticipate a small uptick in inflation, but he's stating those expectations are only temporary. He doesn't see a prolonged inflationary period.
Sense of of what is concerning to you that could challenge the stability of the financial sector?
Well, our policy is accommodative because unemployment is high and the labor market is far from maximum employment. We think that's appropriate. We do monitor all those things carefully. It's true that some asset prices are elevated by some measures. It's true that overall asset prices, I would say, are somewhat elevated. At the same time, we have a very resilient banking system, and we spend a lot of time making the capital markets more resilient as well. So overall, we're in a situation where accommodative monetary policy is working through financial conditions to support economic activity, and that's an appropriate thing.
So what the Fed chairman is stating, you guys, is that certain asset classes, particularly the stock market, was most recently inflated. But what we've experienced the past 3 weeks is a market sell-off. And the chairman is basically stating to us now is that this most recent correction was a healthy correction. As long as the overall trajectory of the markets is upward, we need to see sell-offs along the way. If we don't see sell-offs, corrections along the upward trajectory, what happens is we're building a bubble, and a bubble will eventually burst in our faces. So the chairman is acknowledging this most recent correction was a healthy correction. Otherwise, he does see a bit of inflation in the equities markets. However, the economy as a whole has very tepid inflation, he's stating, and they're going to remain dovish on the economy.
Supply chains, because of course they are challenged.
So those are things like supply chains are, unless they're permanently challenged, there could be take an example of the chips issue with microchips issue right now. The automobile industry is having a hard time getting it. So this is a significant economic issue. And if there's a shortage of cars, then prices of cars might go up. That doesn't necessarily lead to inflation, because inflation is a process that repeats itself year on year on year. So supply chain issues, as we get back up to full economic activity, you could hit supply chain constraints along the way, but that doesn't necessarily mean you will have a higher inflationary process if the Fed maintains its credibility and if inflation expectations remain anchored.
What the chairman is talking about is supply chain issues. He's talking about microchips and semiconductors. He's saying the auto manufacturing companies are not able to obtain microchips in the production of their vehicles. He's stating that's a supply chain issues and it's not really an inflationary concern. He's stating that supply chain issues are market dynamic. Currently, we have supply chain issues due to COVID. For instance, you guys, let's say I own a truck driving company, and I supply grocery stores with their groceries. So a lot of you guys are probably taking notice that the price of your grocery bill is increasing. And a lot of people are thinking, wow, this inflation is for real. Look at the price of my grocery bill. However, the Fed chairman is stating that this is only of a temporary nature due to COVID supply chain issues. A lot of truck drivers were not on the roads during COVID. Myself, as an owner of a truck driving company, I'm going to purchase more trucks. I'm going to hire more drivers, and I'm going to capitalize on this opportunity. And I'm going to provide more supply to meet the demand. As supply and demand meet in equilibrium, prices will then come down. Your grocery bill will then come back down to an equilibrium point. So the price of your grocery bill increasing is a result of COVID supply chain issues. The Fed chairman is stating that supply chain issues are of a temporary nature, and it's just a market dynamic that will resolve itself. It's not an inflationary fear. And I know you guys are saying the 10-year yield is ticking up, mortgage rates are ticking up, but that's part of a healthy economy. Do you really foresee low interest rates for the next decade? I mean, that's not indicative of a strong economy, you guys. That's economy in paralysis, you guys. And when rates tick up rapidly, the markets kind of get shocked and they get spooked and they sell off. But listen, the rates need to go up in a sustained healthy economy. It's just that people are fearful at the pace in which rates are increasing. But that's okay. That's only a temporary sell-off, you guys. And use these sell-offs as opportunities to buy more equities, you guys. Don't be scared out of the marketplace and sell and close out your portfolios and go hide under a rock. Don't do that, you guys. This is a temporary sell-off. Anytime these bond yields are rising rapidly, use that as an opportunity to buy. The market is fearful of drastic moves, right? When the market sees these bond yields spiking, the market sell off. Don't be fearful of that. These are temporary issues. These are what we call binary issues. Take advantage of these binary issues, because this is what I said about an efficient marketplace. Prices always return to an equilibrium. The equities are selling off. They will return to an equilibrium, and use that as an opportunity, you guys. Make some money on these sell-offs. Thanks for watching, you guys. Peace out.